6 days before Ken Griffin bought his entire portfolio at a fire sale price, he sent his investors a letter calling it the best buying opportunity in over a year. The best performing hedge fund on the planet was run by a 25-year-old who'd never managed money before. He invited his investors to send fresh capital by August 1st. That capital never showed up. And 6 days later, Ken Griffin, the richest hedge fund manager alive, running Citadel, one of the largest market-making hedge funds on earth, bought every single one of his positions in a block trade before the market opened. The stocks bounced 18 to 28% that same day. The kid who picked them didn't own them anymore. His name is Leopold Aschenbrenner. After his departure from OpenAI, he published a manifesto predicting the AI boom, launched a hedge fund named after the manifesto, turned $225 million into 20 to 24 billion in under 2 years, and then watched 67% of it vanish in a single month. He was getting married that weekend. This is a story about a guy who may have been right about where the world is going. And it's about why being right almost killed him financially. Here's why this matters to you. If you've ever looked at someone who made a fortune on an obvious trend and thought, well, of course they saw it coming, this story dismantles that logic, because Aschenbrenner did see it coming. He published a 165-page argument explaining exactly what was about to happen in AI, and the market proved him right for 18 straight months. His fund returned 439% through June of 2026. And then leverage, the tool that made all of that possible, turned a 30% market dip into a liquidity crisis that forced him to hand his entire book to a competitor. Being directionally correct and being structurally solvent are two completely different skills, and almost nobody talks about the gap between them. To understand what went wrong, you've got to understand who Leopold Aschenbrenner is. Born in Germany, parents were both doctors, enrolled at Columbia University at 15, graduated at 19 as valedictorian with a double major in economics and math. Tyler Cowen, the economist, called him a prodigy. Others used the word brash. After Columbia, he drifted into the orbit of effective altruism, a movement that argues you should use your career and money to do the most measurable good possible. That led him to the FTX Future Fund, a philanthropy bankrolled by Sam Bankman-Fried. He resigned one day before FTX filed for bankruptcy. There's no evidence he knew the money was fraudulent, but he'd already found the person who would matter most. Avital Balwit, a Rhodes Scholar who'd later become Chief of Staff to Anthropic's CEO, was on that same small team. They resigned together, they fell in love. In 2023, Aschenbrenner joined OpenAI on the super alignment team, working under Ilya Sutskever. His job was to figure out how to steer AI systems smarter than humans. Then a hacker broke into OpenAI's internal messaging system and stole information. OpenAI kept it quiet. Aschenbrenner didn't think that was acceptable. He wrote a memo to the board arguing the company's security was nowhere near strong enough to stop foreign espionage. He got a warning from HR. A few months later, in April 2024, OpenAI fired him. The official reason was an information leak, a brainstorming document he'd shared with 3 outside researchers. Aschenbrenner says management told him the security memo was a major reason for the firing. OpenAI says it wasn't. The company that kept its own hack secret fired the guy who wanted better security. 1 month after that, the super alignment team was dissolved. Sutskever left. And what Aschenbrenner did next is what turned him from a fired researcher into a financial phenomenon. 2 months after being fired, he published a sprawling essay series called Situational Awareness, 165 pages. He argued that AGI by 2027 was strikingly plausible, that superintelligence could follow shortly after, that the real bottlenecks wouldn't be in the AI models themselves but in the physical infrastructure, semiconductors, memory chips, power generation. The speed of the rollout raised eyebrows. Former colleagues speculated he'd been laying the groundwork while still at OpenAI. Keep that detail in mind. The manifesto didn't just make him famous in AI circles, it gave him a thesis that translated directly into trades. The hedge fund launched in late 2024 with roughly $225 million. His co-manager was Carl Schulman, a 45-year-old AI forecaster who'd worked at Peter Thiel's Clarium Capital. Aschenbrenner reportedly put in nearly all of his personal net worth. That matters, because when a fund manager has everything on the line, their conviction can become indistinguishable from recklessness. Here's the trade. On the long side, he bought the companies building the physical scaffolding for AI. Memory chip makers like SK Hynix and Micron, power companies like Bloom Energy and Solaris, data center operators like CoreWeave and IREN, former crypto miners converting their facilities into AI compute. His top 5 positions made up over 3/4 of the long book. This wasn't diversified, this was a concentrated bet with a thesis bolted to it. The other side was just as aggressive. He shorted traditional software companies, most notably Adobe, on the theory that AI agents would erode their subscription revenue. Adobe's subscription business was supposedly bulletproof, the textbook recurring revenue model that Wall Street loves. Aschenbrenner looked at it and saw a company about to be disrupted by the very technology he was backing on the long side. The paired trade had a name on Wall Street: long hardware, short software. And it worked, spectacularly. For the first half of 2025, the fund gained 47% after fees. Then it accelerated. Through June of 2026, the fund was up 439% net. Assets under management ballooned from $225 million to roughly $20 to $24 billion by mid-2026. With only 4 investment professionals on staff. Think about that ratio, $20 to $24 billion managed by 4 people, which is a lot of trust in the algorithm and the thesis. But here's the critical part: leverage, reportedly as high as 400%. For every dollar of investor capital, the fund had $4 of market exposure. That borrowed money came from prime brokers, the big banks that lend to hedge funds and hold the collateral as security. They can demand it back anytime your positions drop far enough. And that relationship, which looks invisible when markets are rising, becomes the entire story when they aren't. At 4 times leverage, the math works like this. A 25% gain in your positions doubles your investors' money. That's the magic. But a 25% decline wipes out the entire equity cushion. That's the trap. And you can't negotiate with the math. Your broker doesn't care about your thesis. Your broker cares about collateral. Now let me walk you through exactly how it broke. Aschenbrenner's long positions, the AI infrastructure stocks he'd concentrated into, fell between 35 and 47% in July. CoreWeave, Nebius, SanDisk, Bloom Energy, all of them cratered together because they were all part of the same trade, and the market was unwinding that trade. When correlated positions move against you simultaneously, diversification across 5 names isn't diversification at all. It's 5 expressions of the same risk. At the exact same time, the short side broke too. Adobe and other software names rallied. The stocks he was betting against went up, while the stocks he was betting on went down. Both legs of the trade lost money simultaneously. The hedge wasn't a hedge anymore, it was a second wound. His prime brokers started issuing margin calls. When you're leveraged 4-to-1 and your positions are dropping 30+%, the brokers don't wait for your thesis to play out. They want their money back, now. They start liquidating your positions whether you agree or not. On July 24th, Aschenbrenner sent the letter. The fund had not been immune to the sell-off, he wrote, but this was a buying opportunity. He invited investors to commit new capital by August 1st. A postscript added, almost casually, "At times we call out opportunities that seem like a particularly good time to add funds, if you have been waiting for one." Nobody bit. Bloomberg reported the appeal didn't garner the commitments he'd hoped for. The brokers kept calling, and the clock kept ticking. By July 29th, the fund was in active discussions with potential buyers for its entire portfolio. Selling stock by stock would have pushed prices down further, which would have triggered more margin calls, which would have forced more selling. A death spiral. The cleaner option was to find one buyer big enough to absorb the whole thing. Citadel won. Before the market opened on July 30th, every long and every short position in Situational Awareness's public equities book was sold to Ken Griffin's firm in a single block. Years of compounded gains transferred in one pre-market transaction. And then the same day, once the threat of forced selling was gone, those stocks bounced. Bloom Energy, Nebius, IRN, SanDisk, CoreWeave, all of them surged while the broad market was flat. The exact positions Aschenbrenner was forced out of hit their bottom the day before the sale and ripped higher the moment he was gone. Ken Griffin has done this before. Citadel has a playbook. Wait for the leverage player to run out of time, buy the positions at a discount, and hold them with enough capital to wait for the recovery. Griffin agreed with Aschenbrenner's thesis, enough to buy the entire book. He just had the balance sheet to survive the trip. Same trade, different structure, completely different outcome. Here's the irony no one can resist. The fund was called Situational Awareness. It missed the risk in its own book. Zero Hedge called it Archegos 2.0 after the family office that imploded on hidden leverage in 2021. Bill Huang had a thesis about media stocks, was right for a while, borrowed against his positions through his brokers, and blew up when his correlated positions dropped simultaneously. The mechanics were almost identical. Others compared it to Three Arrows Capital, a crypto fund that borrowed billions betting crypto would only go up, and discovered that a thesis and a margin call are two different things. A former OpenAI colleague told reporters, "I can't think of anybody that would trust somebody that young with no prior fund management experience." But Situational Awareness isn't dead. The public equity book is gone, but the fund still holds a roughly $5 billion stake in Anthropic, acquired when the company was valued at $60 billion. Anthropic was last valued at $965 billion in May and is expected to go public as early as October. A private stake can't be margin called. There's no daily mark, no prime broker breathing down your neck. That's why it survived when everything else didn't. The illiquidity that makes private investments inconvenient is exactly what made this one indestructible. Even after the July wipeout, early investors who put in $100 million at inception still have about $230 million. They're up. They just watched most of their unrealized fortune evaporate in a month. And Leopold Aschenbrenner, the week his fund was dying, was in Carmel, California, preparing for his wedding to Avital Balwit. The Wall Street Journal described a lavish affair. His bride's employer is now the primary asset holding his financial future together. Her boss's company is his largest remaining investment. So what does this story actually teach you? Something that almost no financial commentary bothers to explain. There's a difference between a thesis and a trade. A thesis is a view of the future. A trade is a structure that expresses that view with borrowed money and a broker who can sell you out on a Tuesday morning. Aschenbrenner's thesis was right. His fund predicted the AI infrastructure build-out before most of Wall Street took it seriously. The capex numbers proved him right. Amazon, Microsoft, Google, Meta and Oracle are projected to spend over $600 billion in capital expenditure in 2026 alone. He saw it coming, he was early, he was correct. But a thesis doesn't have a margin call. A trade does, and when you lever a correct thesis 4-to-1, concentrate it into a handful of correlated positions, and bolt on a short book that can reverse at the same time, you've built something that can't survive a bad month. You've confused being right with being solvent. Let me say that again. You've confused being right with being solvent. Those are different things. The market doesn't reward conviction, it rewards survival. Griffin understood that. Aschenbrenner, for all his intelligence, didn't. Or he did, and he bet that the drawdown wouldn't come before the payoff, which is the same thing as not understanding it. Remember the manifesto? The opening line was a claim about who could see the future. Aschenbrenner wrote that the reality of what was coming was visible to only a few hundred people, most of them in San Francisco and the AI labs. He included himself among those with situational awareness. The rest of the world, he said, had not the faintest glimmer of what is about to hit them. He was probably right about the world, he was wrong about himself.